What's going on, everybody? Let's start today with the partnership tax return, the basics of a 1065 or a partnership tax return. When you need to file a partnership tax return, if you have two or more partners in a business, a single partner goes in a single member LLC or Schedule C. But when you have two or more, they got to get their own form and they got to get their K1s. So, what is a K1? What is a partnership tax return? What are separately stated items that my managers keep talking about? So let's go over it. Right here, this is your front of the page, front of the 1065. You're typically going to get a trial balance, a general ledger, a few other items that make up the financials that go into the tax returns. What is a trial balance? Just shows all the balance sheet items and the profit and loss items and retained earnings. And so that's going to have some of the separately stated items or some of these expenses broken down. So let's go over what that means. You got revenue. You got gross income, gross sales. That's going to go on your gross receipts. You're going to have different categories for expenses: office supplies, meals, repairs, dues and subscriptions, things of that nature, different categories. And the whole point here is you're breaking it down into where they belong: repairs and maintenance, rent, taxes and licenses, interest expense, retirement plans if they got them, and then this wide category of other, where dues and subscriptions would go, and some things of that nature. It's important to categorize that. It's important to have that written out in that other statements, and it's going to have a statement in the back. You're going to have all those broken down and written out. Some managers like them capitalized. You could do that too. Now, here's what's important. This net income from this page one, this is your ordinary business activity. Like if you're a manufacturer or even if you do professional services, it's all going to go here, income and then expenses. But then, and by the way, these are some questions we'll get to later, but don't skip over those. Read them, try to understand them, and ask some insightful questions. But I'll move past that for a second. Now, right here on Schedule K, that's what's known as separately stated items. Why are they separately stated? Because they get allocated to the partners on the K1 at their ownership percentage. If you have a 50-50 partner, a husband and a wife, or two unrelated folks that are in a business together, and the ordinary income from page one that I mentioned before is allocated 50-50. Well, if it's 100,000, split 50-50, 50,000 each on their K1s. But sometimes in that trial balance, you're going to see charitable contributions. And you're going to think to yourself, where are these going? Where are they going on their return? I don't get it. Well, they're going to go in Schedule K on the deductions and be separately stated. So in the inputs, typically in most softwares, they're going to be in like the Schedule K input. So you're going to be putting them in Schedule K, deductions, charity. So don't be trying to look for them in that line item, like, page one line item, ordinary income. Just be mindful that some items may hide in this separately stated item. Some of the other examples are short-term, long-term gains, recapture, rental real estate, which I'll touch on later. And again, distributions will go here as well. All these items that affect and go on the individual's K1s separately stated. So then you're going to get the K1, and then you're going to be able to put that into their tax returns. That's going to be phase one. I'm going to have a few other videos. We'll jump into K1s. We'll jump into balance sheets and all that. But just as a high-level overview, the balance sheet, beginning and ending. Some people do blank them out. Sometimes when you're in the bigger firms, you're going to want to show them no matter what, even if they meet the criteria to be blanked out. What is that criteria? Again, when you're reading through the questions, you will see it is question number 4. Does the partnership satisfy all 4? Gross revenue, gross receipts under 250,000, total assets under $1 million, and a few other items that allow you to blank out the entire thing. It's not ideal to do this because sometimes you may want to have that information available, like the basis or the capital accounts of the partners is important to track. And if you had years where you blanked it out, it would be hard to recreate. I hope that's helpful, and we'll have some more videos coming up.